Imagine two people standing at the edge of the same river. One person jumps in every day, trying to catch fish with their bare hands. Sometimes they succeed, sometimes they slip, sometimes they get hurt. The other person builds a simple net, places it carefully, and lets time and patience do the work. Both want food, both want success, but only one understands the power of waiting. Today, we're going to talk about why investing, slow, steady, and patient, is often better than trading, which is fast, stressful, and unpredictable. This is not about getting rich overnight. This is about building wealth over time with clarity, confidence, and peace of mind. So take a breath, get comfortable, and let's begin. Chapter 1. Understanding the difference. Before comparing investing and trading, it's important to understand them in a simple, everyday way. Trading focuses on the short term. A trader buys and sells frequently, sometimes within minutes, hours, or a few days, trying to make money from small price changes. The goal is to guess what the price will do next and act quickly before it changes again. Investing, however, is about the long term. An investor buys assets like companies or funds with the belief that they will grow in value over many years. Instead of worrying about daily ups and downs, investors focus on overall growth over time. In simple terms, trading asks what will happen next, while investing asks will this be worth more in the future. This difference in thinking is powerful because short-term predictions are uncertain, but long-term growth allows time, patience, and consistency to work in your favor. Chapter 2. The illusion of control in trading. Trading often feels exciting and powerful because prices move quickly and every decision seems important. When charts flash red and green, it creates the feeling that if you just learn one more strategy or indicator, you can control the market. But in reality, the market is influenced by millions of people, global news, emotions, and unexpected events. No single trader can truly control or predict all of that. Most short-term price movements are just noise, not clear logic. As a result, trading often becomes a cycle of reacting to news, to fear, and to greed, and emotional reactions usually lead to poor decisions. Chapter 3. Stress versus stability. Trading demands constant attention and can be mentally exhausting. Traders often watch screens all day, worry about losses, and constantly question their choices. Even when a trade is successful, new doubts appear, such as whether they sold too early or bought at the wrong time. Investing is much calmer by comparison. Once you invest thoughtfully, you don't need to monitor prices every minute. You allow time to do the work. This approach brings patience, confidence, and peace of mind. And peace of mind, while often overlooked, is a very valuable form of wealth. Chapter 4. Time is the investor's greatest weapon. One of the biggest advantages investors have is time, something traders often underestimate. Over time, businesses grow, innovations develop, earnings increase, and overall value expands. Investing allows you to benefit from this natural growth through compounding. It's like planting a tree. You don't keep digging it up to check if it's growing. You water it, protect it, and let time handle the rest. Trading ignores this process, while investing fully embraces it. Chapter 5. Compounding, the quiet superpower. Compounding isn't exciting or dramatic, but it is incredibly powerful. When you invest and reinvest growth over long periods, even small amounts of money can grow into something meaningful. Trading, however, often resets the clock because you constantly enter and exit positions. Investing keeps the clock running. The longer your money stays invested, the stronger compounding becomes. This is why patience often delivers better results than pure skill. Chapter 6. Costs you don't see. Trading comes with many hidden costs that people often overlook. These include frequent transaction fees, higher taxes on short-term gains, poor timing, and mistakes driven by emotion. Even small costs can add up when repeated many times. Investing usually involves fewer transactions, lower overall costs, and better tax efficiency over the long term. In the end, protecting what you already have is just as important as trying to grow it. Chapter 7. Emotions are the real enemy. Most people don't struggle in the market because they aren't smart enough. They struggle because they are human. Fear leads to panic selling, greed leads to risky buying, and ego leads to overconfidence. Trading constantly triggers these emotions because decisions are frequent and urgent. Investing helps reduce emotional decisions by focusing on long-term goals, real value instead of hype, and discipline instead of impulse. When emotions are under control, decisions tend to improve.
Chapter 8. Consistency beats brilliance. Trading often highlights big wins and dramatic success stories, making brilliance seem like the goal. But brilliance is rare and unreliable. Consistency, on the other hand, is powerful. Investing rewards steady behavior, regular contributions, and long-term thinking. You don't need to be right every time, you just need to avoid major mistakes. Slow and steady progress that continues over time is far more valuable than fast gains that disappear quickly. Chapter 9. Most traders don't win long-term. This is a difficult truth, but an important one. Many people try trading, and very few succeed in the long run. Traders face intense competition from professionals, advanced algorithms, emotional pressure, and unpredictable results. Investing is different. It doesn't require beating others or outsmarting the market. It simply requires staying invested and allowing long-term growth to work. You're not competing, you're participating, and that makes all the difference. Chapter 10. Investing builds real ownership. When you invest, you are not just buying numbers on a screen, you are becoming a partial owner of real businesses or assets. This means you benefit when companies innovate, grow, and become more productive over time. Your money is connected to real-world progress and value creation. Trading, in contrast, often feels disconnected from reality, turning investing into a game of price movements rather than ownership. Investing ties your growth to actual economic development. Chapter 11. Freedom over time. Trading often requires constant effort and attention, much like a job. When you stop trading, the income usually stops as well. Investing works differently. It helps build systems that can grow quietly in the background while you focus on studying, traveling, resting, or enjoying life. True wealth is not only about money, it's about having freedom over your time and mental energy. Investing brings you closer to that freedom. Chapter 12. Long-term thinking shapes character. Investing naturally teaches important life skills such as patience, discipline, delayed gratification, and emotional control. These qualities are valuable not just in finance, but in everyday life as well. Trading, on the other hand, often encourages impulsive decisions, short-term thinking, and emotional reactions. Over time, the habits you build through investing can shape you into a calmer and more thoughtful person.
Chapter 13. Boring can be beautiful. Many people describe investing as boring, but that is actually one of its greatest strengths. Boring means predictable, sustainable, and repeatable. Most successful investors didn't chase excitement or quick wins. They focused on simple, steady strategies. While excitement can be entertaining, stability is what creates lasting wealth. Chapter 14. When trading might make sense. Trading is not inherently bad, and for a small group of people with deep knowledge, strong discipline, plenty of time, and emotional control, it can work. However, for most people, especially beginners, investing offers better chances of success, lower stress, and stronger long-term results. Choosing investing doesn't mean aiming lower, it means choosing a smarter and more reliable path toward growth. Conclusion: the quiet path wins. Let's return to the river. One person keeps jumping in, chasing each fish, exhausted by the effort. The other checks the net occasionally, adjusts patiently, and trusts the process. Over time, the second person gathers more, without chaos, without constant struggle. That is investing. Not flashy, not dramatic, but powerful. If trading is a sprint, investing is a marathon, and in life, marathons shape the strongest finishers. So choose patience, choose consistency, choose the quiet path, because in the long run, time rewards those who respect it.